Welcome to Closing the Transaction with your host, me, Joseph J. White. In this tutorial, we will be covering the following topics: estimating closing costs, including discussing common closing costs, electronic land registration, the closing process, and the interest adjustment date. So, let's get started. Closing the transaction is a step in the process that can be overlooked by the new mortgage agent, resulting in confusion on the part of the borrower and or failure on his or her part to have adequate funds to pay the closing costs. In this section, common closing costs will be detailed as well as the lawyer's role in the closing process. By understanding the process, the mortgage agent can advise his or her client on what to expect, thereby reducing or removing the confusion and stress experienced by the borrower. Estimating closing costs. Before a transaction can close, it is vital that the borrower understand and be prepared for the closing costs associated with the transaction. Failure to prepare for these costs has caused many transactions to be canceled at the lawyer's office because the borrower didn't have the funds to close. The exact amount required by the borrower on closing differs based on the type of transaction, but a mortgage agent should ensure that the borrower has between 1.5% and 3% of the purchase price set aside for closing costs. To estimate the costs involved in closing, the mortgage agent should advise the borrower of typical closing costs. Now let's look at a few estimates of closing costs in a sample transaction. There are several closing costs associated with each type of transaction. For example, Bob and Mary are purchasing a resale home for $420,000, and assuming this property is not in Toronto, the closing costs for this transaction may be approximately, starting off with the appraisal fee. In this case, we didn't have an appraisal fee, so the closing cost here would be $0. Closing adjustments could be approximately $350. And closing adjustments tend to be those amounts that the vendor has prepaid and that is going to be paid back to the vendor on closing. So that's what the purchaser now has to provide to the lawyer on closing. In this particular case, there is no status certificate fee payable because this is not a condominium. Now, although the home inspection fee is not payable on closing, it's important for us to advise the borrower of all of the costs involved in closing the transaction because these will be costs that the borrower has to pay before the transaction closes. The next amount here is an interest adjustment, and this is based on 10 days at a semi-annual interest rate of 6%. The land transfer tax is $4,875, and that varies based on the municipality that the property is located in. Legal fees, $2,150. There is no new home warranty, so that's $0. There's a new hydro account deposit required in this case, so we're looking at $200. Property insurance fee of $50, that'll be the first premium. PST on the CMHC premium at 8%, and we're looking at title insurance of $250. So, you could see that if the borrower was advised to come up with 1.5% for all of these closing costs, the borrower would be short funds. Hopefully the borrower wouldn't be short on the day of closing. Now let's have a quick look at electronic land registration, or EREG. This is a system that has revolutionized the way documents are produced and registered, primarily in Ontario. The 200-year-old paper-based system was replaced by EREG, a completely electronic, paperless system where documents are created, registered, and warehoused in an electronic format. The system contains records for over 5 million parcels of land in Ontario. So if you are doing business in Ontario, please refer to the manual for specific details on electronic land registration. Okay, now let's have a look at the process involved in closing a transaction. What I'm about to discuss is a brief description of the process and includes the steps involved in the purchase of a property with a mortgage. So the first step is that the purchaser's lender is satisfied that all conditions have been met. Next, the client or lender decides on which lawyer to use. Certain lenders will have a specific lawyer they wish to use to close the transaction, while others will allow the client to use his or her own lawyer. If the client uses his or her own lawyer, it's important to note that this lawyer is working for the lender, and while the lawyer has a responsibility to provide disclosure to the client, his or her main responsibility is to the lender. Next, the lender sends the closing lawyer an instructions to solicitor package. This package commonly contains a copy of the lender's mortgage approval, the lender's disclosure statement, the solicitor's final report and certificate of title, the solicitor's interim report and requisition for funds, the pre-authorized debit form, acknowledgement and direction, instruction on requirements for title-insured mortgages and non-title insured mortgages, and requirements regarding property insurance, surveys, condominium units, proof of identity, etc. In addition, if the lender is prohibiting secondary financing, such as a vendor take-back or a second mortgage, the lawyer is required to inform the lender if he or she becomes aware of any secondary financing. This may cause the transaction to be canceled. Next, the lawyer meets with the client. The lawyer performs due diligence, such as obtaining proof of identity in the form of photo ID, and has the client sign the acknowledgement and direction. This document allows the lawyer to act on the client's behalf, register documents electronically, and includes authorization to use the Document Registration Agreement, or DRA. The DRA allows solicitors to exchange documents, checks, and keys before closing, for example, if the transaction is a purchase. Next, the purchaser's lawyer prepares and sends the documents. The purchaser's lawyer prepares a draft e-reg deed, performs that required searches, sub-searches, and sends a requisition letter to the vendor's lawyer. Then the vendor's lawyer receives the documents, including the requisition letter, and the lawyer reviews the e-reg deed and confirms use of the DRA by responding to the purchaser's lawyer. Then the purchaser's lawyer receives those documents. The purchaser's lawyer receives a response to the requisition letter, updates the e-reg deed if necessary, and finalizes the registration documents. Then the vendor's lawyer sends the purchaser's lawyer the closing documents. The purchaser's lawyer then requests funds from the purchaser's lender. And now the lender gets involved. The lender sends funds to or deposits funds into the purchasing lawyer's trust account. The purchasing lawyer sends documents and closing funds to the vendor's lawyer. The vendor's lawyer receives all those documents and the monies. Then the purchaser's lawyer registers the discharge or cessation of mortgage, transfer deed, charge mortgage, and advises the vendor's lawyer of registration. The vendor's lawyer then releases the funds and documents and sends money to the original lender to discharge that current mortgage, if there is one in place. The purchaser then gets their keys, garage door openers, security codes, and so on. The next step is that the purchaser's lawyer advises the tax and assessment departments, condominium corporation, if applicable, of the change of ownership. The purchaser's lawyer reports to the title insurer and remits the premium, again, if applicable. The purchaser's lawyer sends closing reports to the vendor's lawyer, the lender, and the new homeowner. The lender then remits the insurance premium to the mortgage default insurer if there is one in the transaction. Next, the lender sends the mortgage brokerage its finder's fee, if applicable, and I know this is about time, the mortgage brokerage pays the mortgage agent the contracted percentage of the finder's fee. And now that we've done this, we get to do it all over again in another transaction. Now let's have a look at the interest adjustment. Mortgage payments are made in arrears, meaning that a monthly payment made on October 1st, for example, actually covers the payment due for the month of September. If a mortgage is funded exactly 1 month before the first payment, the first payment will cover the principal and interest due for that month exactly. However, if the mortgage is advanced on August 15th, for example, and the repayments are monthly on the 1st of every month, the first regularly scheduled monthly payment must begin on October 1st. Therefore, the first monthly payment will only pay the principal and interest due from September 1st until October 1st. This leaves interest due from the date of advance to the period exactly 1 month before the first payment. In this example, the borrower would have the mortgage proceeds from August 15th until September 1st without paying interest on those funds. The due date for the payment of this interest is referred to as the interest adjustment date. The borrower is advised by the lender of this amount, normally by letter or by the lawyer closing the transaction, and a check is due on that date. Some lenders will deduct the amount of the interest on the date of closing, saving the borrower the aggravation of having to make an additional payment. However, if all of the mortgage proceeds are required on closing, the borrower can pay the interest adjustment on the interest adjustment date. With flexible mortgage repayment dates, a payment may be set up to be made exactly 1 month after closing. However, a borrower may prefer the payment to be set at the beginning, middle, or end of the month based on his or her specific budget. If the mortgage is advanced at any time greater than a month before the first payment, an interest adjustment payment is required. The same is true for any other payment frequency. For example, if the payment is weekly and the mortgage is advanced 10 days before the first payment, there's an interest adjustment amount payable. When an interest adjustment payment is calculated, the term and amortization of the mortgage are not involved. For a detailed example of how to calculate the interest adjustment payment using the HP 10B or the HP 10B2 calculator, please refer to your course manual. And that brings us to the end of this module. Your next step is to ensure that you read the chapter in your textbook and complete the chapter review questions. The answers to those questions are at www.remic.ca.